So we've officially hit bear market territory in the stock market, and the chances of a recession are increasing by the day. What does this mean for you and your investments? Stick around and let's get into it. Hey, welcome to another video from One Up Financial. I am your host, Eric Persogna, CPA and Certified Financial Planner, here to help you increase your income, reduce your taxes, and invest smarter in retirement. I've had a lot of investors ask me questions this year about whether they think a recession is going to happen in 2022 or next year, and some actually believe that we're already in a recession. I'm not here to opine on when I think a recession is going to happen because, frankly, I really don't know. And anyone that tells you that they do know the precise time of when a recession is going to be announced is fooling themselves and fooling you. Because one, it is impossible to accurately and consistently predict the future, whether it's the stock market or a horse race. Number two, the stock market is not the economy. The two do not move in tandem with each other. Going back to the 1940s all the way to, I think, 2020, if you look at the data, the stock market typically reacts or discounts itself prior to a recession officially being announced, meaning in general, sell-offs typically occur before a recession is actually announced. So we could see the market come back from the lows before a recession is actually announced. The two do not move in lockstep, so even if you correctly predict when a recession is going to happen, the market may have already recovered. Instead of trying to predict when I think a recession is going to occur, I want to focus this video more so on what happens during a recession typically, and what investors can do to help mitigate the downside to their investments. So quickly, I just wanted to define what a recession is because I think a lot of people have their own definition, right? So I'm going based off of the National Bureau of Economic Research, and the way they define it is a long period of a decline in economic activity. Pretty broad definition, right? So what I like to do further is go back to 2008, 2009, the Great Financial Crisis, because I think that's a pretty good definition of a recession. So during that time frame, I think it was in December of 2007 all the way through June of 2009. So during that time frame, the gross domestic product, or GDP, which pretty much measures the economic activity of our country, declined 5 out of the 6 quarters during that time. So that's a pretty consistent and precipitous decline in GDP over that roughly 15-16 month time frame. And I think that's a pretty good definition of what a recession is. Now, if you look at the current economic environment today, by that definition, we're not necessarily in a recession yet, but we could be heading there very soon. During recessions, again, just based on data, based on facts, I like to go based on those things as opposed to opinions. Going back to history, back to the early 1900s, all the way up until 2021, so even capturing the most recent recession with the coronavirus, typically what you see is, number one, a decline in the stock market. That's pretty obvious, right? We're already down about 20% or so this year. And again, going back to 2008, the Great Financial Crisis, stock market, I think, had a max drawdown of around 44%. Now, I'm not saying that we are going to see those kind of lows in the near future, but I am saying that I wouldn't be surprised if we saw further losses from here. So just be prepared when you open up your 401k statement. Another thing we typically see with recessions are companies that are coming up short of their earnings and revenue projections. We've already kind of seen this a little bit with Target and Walmart. Their most recent quarter, I believe they missed on their earnings estimates and their guidance forward, so their projections going forward for the rest of this year were a little bit lower than what Wall Street had projected. Generally, in recessions, you see companies start to earn less than what they anticipated and what the analysts on Wall Street anticipated, and you start to eventually see a sell-off because people lose confidence in those companies and in the stock market. Another thing that we typically see in recessions, you've probably already seen it now, are really scary headlines. And I would say just remember that a lot of these news publications are trying to capture eyeballs. They want to sell ads and they want your attention. So they're going to put out headlines that are there to capture your attention and read or watch whatever content that they produce. So just keep that in mind and don't overreact to some of the things that you might see in the journal or on CNBC. Another thing that's pretty common with recessions is high inflation and high unemployment. Now, we already have high inflation. That's pretty obvious with prices of everything just going through the roof. I think inflation's 8 or 9% right now. But what we don't necessarily have is high unemployment. The unemployment rate is still relatively low at, I think, just under 4% or so. Now that may change in the future, but generally with recessions, we typically have a lot of people out of work and we have prices going much higher. Another common factor too in recessions, and this is pretty, if you think about what drives our economy, is consumer spending. 70% of our economy is driven by the consumer. So if we have a recession, that generally means that people aren't buying as much, they're not saving as much, and their debt levels are increasing because they can't afford the high prices that they're paying at a grocery store or the mall. And obviously you have bankruptcies and companies going out of business, things like that. Really, a recession is very difficult to navigate and it's not pleasant for really anyone. So those are just some of the things, at least based on history, that you may expect to see if and when a recession is announced. Now I want to focus more so on what investors can do when a recession is present. Some strategies that you can use and some things that you might want to consider if and when a recession does happen in the US. So number one, and this is going to sound pretty obvious, and I know that everyone always talks about having a retirement plan or a financial plan. And while that's true, I think everyone should have a very well thought out and detailed, comprehensive financial plan. At a bare minimum, just have a plan. Whether it's having 12 to 15 months of cash set aside or transitioning your portfolio from a 60-40 to 20% in alternative investments. Whatever you do, just be sure that you have some kind of proactive strategy that prepares you for when the market drops considerably, like we see in recessions. The last thing you want to do is be unprepared, look at your statement, worry that the market and your investments are down 40 or 50%, and then sell, go to cash, and wait until things get better. Be proactive, have some kind of basic plan in place so that you're prepared for when a recession does hit. Number two is be honest with yourself when you're defining your risk tolerance for an investment strategy. What I mean by that is I've seen cases where investors will tell me that they're comfortable with risk and that they're okay with the ups and downs in the market because they know over the long term that everything is going to be fine. That's easy to say when we are 10 years into a bull market. It's much harder when the market's down 20 to 25% and you've lost $300,000 or $400,000 in your investments. When you are establishing an investment strategy, really be honest with yourself and focus on the downside. Look at that maximum potential loss in whatever that proposed strategy is and be sure that you're really comfortable with that. Equate that potential loss to dollars. Typically it's shown in a percentage form, but equate that quickly to dollars. So if it's, a maximum up and down in your portfolio of, let's say, 30%, you have a $2 million portfolio, make sure that you're comfortable with a $600,000 loss at any given time in your investment strategy. Next is very important for those that are nearing or in retirement, and that is to have cash reserves and have a cash strategy for your investments. So the last thing that you want to do when we're, let's say, potentially in a recession and the market's going down is have to go into your investments, your IRA or your investment account, and sell out of your portfolio to have enough cash to pay for living expenses in retirement. You want to be able to have a nice buffer, a nice cash reserve built in like an emergency fund that might cover anywhere from 12 to 24 months worth of living expenses. Some people go more, some people go a little bit less, but you want to make sure that you have a really nice cash cushion for when instances like this, like a potential recession, do occur. And in addition to that, you also want to make sure that you have some kind of income generating investments in your portfolio. And it's not enough to just have those dividend kind of investments and those bonds that are paying a decent interest rate. You want to be able to know when to expect that cash flow, because some funds will pay monthly, some will pay quarterly, some will pay annually. And if you're trying to project out over the next year or two how much cash you need for retirement so that you don't have to sell out of your investments, you want to know exactly how much you have sitting in liquid cash and how much you can expect to receive on a monthly, quarterly, or annual basis from your investments. Next is simply to rebalance your portfolio. When the market is down, generally speaking, for the most part, bonds or safe haven assets, if you will, tend to go up because investors flock to safety, right? They sell out of their stocks, they go to cash, they go to fixed income because they want to stay safe. And that in turn drives the prices of bonds up. What you have is someone who may have established, let's say, a 70% stock, 30% bond portfolio at the beginning of, let's say, 2022. And now it might look maybe closer to 50% stocks, 50% bonds because their stock portfolio has gone down considerably more than their bond portfolio. So what you want to do at that time is consider rebalancing or selling the bonds or the portion of your portfolio that's actually gone up a little bit and buying more of the stocks that have gone down to get your weightings a little bit closer to that initial target of whatever you established, in this example, 70% stock, 30% bonds. Next is tax loss harvesting. And I feel like I talk about this on every other video that I do, but it is very important, especially now with pretty much every asset class down this year. And tax loss harvesting is nothing more than selling an investment in a taxable account that has gone down in value to realize that loss and use it as a deduction against your income. It's a very effective strategy to use, especially in bear markets. But there are some things to consider and there are certain rules and regulations around that. So I would consult with your tax or financial professional before considering implementing that tax loss harvesting strategy. Lastly, tell yourself or call me and I will tell you that this too shall pass. Again, I'm big on data, the facts. So going back to the 1940s all the way through 2010, the average recession has lasted roughly 15 to 18 months. Now, I know that sounds like a long time, but just remember the one common theme in every single recession is that they all end. This one, if we're in one or if we're nearing one at the moment, it will end. This too shall pass. What you don't want to do is panic and sell out of or get out of whatever established investment strategy you're in and go to something safe and wait it out until things get better, because that almost never works. We can't time the market, but what we can do is stay calm and collected, have a good plan, maintain that strategy, and don't lose focus of what our long-term objectives are. Are you concerned about a recession and what it might mean for your portfolio? If so, please don't hesitate to call or email me. I will respond to you personally. Thanks as always for watching our videos. If you are interested in staying up to date with our market and financial commentary, please subscribe to our blog at oneupfinancial.com/blog or follow us on LinkedIn and Facebook. Thanks again. We'll see you in the next one.